Good evening, everyone. Senthil here. Is my audio and video clear? So, can you see my screen and hear my voice clearly? Thank you, everyone. So, first of all, apologies for the last two sessions was delayed or cancelled. So that was unexpected. So, really apologies for that. And so far, it never happened like this. The last 4 5 years, we have never rescheduled. Right. So let's continue. So Prabhu today also he is occupied. So that is the reason I am taking one session prior to that. So let's start. And so today we are going to learn about covered trading. So derivative strategy we are starting today. Derivative strategy one, naked trading plus covered trading, one future plus one option. So this is what we are going to learn today. Yes, sir, Srikanth sir, what is your doubt? Please tell me. We can address that first itself. Regarding the videos, you can check with the Phoenix tech support team, Satish. So his number is 98416742234. You can take down this number and you can call to Satish or 996204647. So you can take down these two sessions. So whatever the recordings you want, he'll provide you. Okay. So let's start. Covered trading, as I told you, it's going to be on covered trading. Disclaimer. So hedging. So what is a hedge? A hedge is an investment that is made with the intention of reducing the risk of adverse price movement in an asset. So that means while trading in cash market, what we used to do, so even let us say my capital is 10 lakhs. So will I buy everything in one single stock? No, right? So what I'll do, I'll buy 1 lakh rupees, 2 lakh rupees, 1.5, 75,000. So like this, I'll split and buy. So even if there is a huge gap down of 5% or 10% also, it is not going to give me a very big impact in that particular portfolio, right? Say like for example, out of 10 lakhs, one stock is, I have taken one stock for 1 lakh rupees and it is 10% negative, 10% negative. So what is my loss? 10,000. So it is manageable when the portfolio is 10 lakh rupees. Subsequently, this can be considered for 1 lakh or 50,000, whatever it is, right? But when we trade in derivative, when there is a gap down of 5%, so this gives us a very big impact. Either it may be in options or in futures. Future, it will be a big hit. So to avoid this only, we should always trade in derivatives with the hedge. That means we have to cover the trade with opposite position for a security as a minimum insurance, right? So when we tell about hedge, let's understand a hedge is a investment that is made with the intention of reducing the risk of adverse price movement. If there is a huge gap up or gap down, yes, to manage that loss, the bigger loss will be controlled. So for that only we are taking a hedge. Normally, a hedge consists of taking an offset or opposite positions in a related security. So that means when you trade in SBI future, you cannot do hedge with ICICI Bank, or you cannot do hedge with Nifty. So you have to hedge with SBI in the same instrument only. You have to hedge with option. So in equity trading, we can create positional positions based on hedge itself to minimize the risk. So hedging is called covered trade, naked or uncovered open positions. That means, example, any future positions long or short with option, without options, not covered with options. So like for example, I am buying one lot Axis Bank future at 875. I am buying whatever is the day I am buying today, one lot. Simply I am buying here. So you can see here now my capital required is 1.18 plus another 30-40,000 for risk management or money management. My profit is unlimited, loss is also unlimited. So both the side, one is benefits are there, the disadvantage is also there. If it is moving towards my favorable direction, I'll make very good profit. If it is going against my favorable direction, I'll make very big loss. So three such losses will damage our capital completely. So to avoid this only, we have to cover the positions with another instrument in the same security. Or I am selling one lot future long at 512, whatever it is. Axis Bank short at 875. Either you go long or short, still you have to create a hedge. Any option, any open options which is not covered with opposite option. So for example, buying a CE and PE. So this becomes a straddle, or selling both the side option, that becomes strangles. So like this, many options are there. All those things we will see. For example, I buy one lot 420 call option for any particular security at 12 rupees. It is not covered. So the one best thing is the risk associated here is zero. That means it can go up to zero only. There will not be any negative value. So that is the minimum thing which is acceptable. Other than that, yes, it is still. If you buy 10 lots here, everything going on zero, no point of trading, right? So how to control this? How to do a damage control? So you should not think that I will be losing big profits. No, big profits is not the expectations, or that should not be the task. Our requirement in equity market or derivative market is, right, small consistent profit. So this should be our target. Usually what happens, many times when I buy some option at 50 rupees, my target will be like 60. Say like usually I take for 75 or 85 rupees. Okay, I book at 85 rupees, or I book a stop loss at maybe like 68. I'm sorry, 68 or 65. Maximum 10, 12 points will be my stop loss. So I'll book it, or 63 will be my maximum stop loss. I book it. So whenever I book profit, so what happens? After that, it goes to 150. So we'll regret very badly, right? So we should have hold it, but that is not required. We should be prepared that this is not the only trade we are going to get in a week or get in this month. You will be getting 10 such trades in a week. 10 such trades in a week. For example, I am giving Nifty option. Okay, it's an open option. Just for an example, I am telling, kind of related to small consistent profit. So if we can make 10 trades into 10 points into 10 trades, it becomes 100 points per week. I'm telling, including crossing all the losses, all those things. So this is a scalping method. So like for example, if you trade 4 lots is how much capital required if you want to buy a buy a premium. Say like for example, how much? 75 rupees. We require 15,000 into 2 or 3, 45,000 we require as a capital. Premium we deploy only 15,000, but capital required is 45,000. So 45,000 in per week, if we can make 20,000 rupees, is this big or not? Is it small or big amount? Let's discount even 50 points. Now tell me, is this good amount or not? Yes, I'm repeating again. Premium value should be Nifty option. The buying value should be in between 75 to 80 or 60. We can keep. So our target should be only 8 points, 10 points. That much is sufficient, right? If we can get only 50 points per week, just 50 points per week for 4 lots, your profit will be 10,000 rupees per week, right? Now let's multiply this only by 2 times, because every day we cannot fully occupy ourselves, right? We cannot occupy ourselves fully. So still it is higher the returns. The ROI is very high. Number one, if you can maintain this throughout the year, I'll say there is nothing better. So for this is the value of small, this is the power of small consistent profits. Are we clear, sir, madam? Don't try to enter an option for 100 rupees and make it 300 rupees. Nobody can do this. Nobody can do this, right? So coming back to our topic now, cover trading, cash, future options. To minimize the risk in any open positions, it can be cash, future or options. We have to take opposite positions in the same security with different instrument. Cash positions can be covered with futures or options. Future positions can be covered with options. Option positions, long or short, can be covered with options. So we can do this. With increase in capital, shall I increase lot size? Yes, you can do, sir. You can go up to even 10 lots. Till 10 lots, it's nothing, right? But the only thing is you should be having the mindset to tolerate that loss. Back to back 3 loss hits. We should have that potential to digest that. That is the only requirement. Initially, start with baby steps. 1 lot for 3 months, you will get used. Then increase to 2 lot, another 2 months. Then increase to 4 lots. So by this time, 1 year will get over. You will be very clear with the trading system. Then you can increase the lot size to 10 or 5 maximum. So let's study in details with examples. So now future to option, future to option. So now coming back, I am buying 1 lot future of this particular stock at 1067. So now in 3 days, if the stock is going 3% or 4%, 20,000 rupees profit, it is very, very good on a capital of 1.18 lakh, almost like 20%, right? 15%, which is very good. But at the same time, so now when we take a future trade, at least we have to keep 1.5% stop loss. Minimum 1% we have to keep a stop loss, right? We cannot keep a stop loss less than that. So when you keep 1.5%, what is happening? Straight away 10,000 rupees is going. So to adjust this, what we used to do is always cover your future trade with opposite side option with 1 lot. That means I have bought a future. My trend is upside. Now I'm going to cover this with 1 lot put option ATM. 1 lot put option ATM buy. ATM buy. So now here I am in upside direction. When I buy a put option, I am in downside direction. Are we clear? So still risk is involved. How much? If you see here, the maximum loss can be only 13,000. It cannot go above 13,000. Are we clear, sir, madam? Any doubt? Whatever happens, if market is completely crashing to down to earth also, your loss will not be more than 13,000 rupees. That is guaranteed. It can be 13,200, 12,800, 200 rupees, 300 rupees above or below, but it will never go beyond this loss. Next, the best part is profit is still unlimited. If trend is going towards your direction, profit is unlimited. See, when market is going up, what will happen? This put option will become zero completely. So future will start giving you big profits. So let's see that. Before that, now you see here the capital required is only 40,000 rupees. From 1.18 lakhs capital, it came down to 40,000 rupees. You add another 20,000 rupees for a money management. If things goes wrong, we need again funds to take the next trade, right? So you can see here with 60,000 rupees, 1/2 of the span margin we can trade in the same future. So now, what is the minimum requirement? Stock has to give minimum 2 to 3% movement. 2% movement in intraday. 2% movement in intraday. Future will give you 13,000 rupees profit, right? Put option will give you 5 to 6,000 rupees loss. That is the purpose of the trade, right? That is the purpose of the trade. That is the purpose of the trade. Why we are adding this is to minimize my risk. Okay, sir, this side I am losing the profit because of this put option. Okay. Now what happens if it goes against me? Right? What happens if it goes against me? Even if the stock is going down 1.5%, this loss is manageable, right? You assume that the capital is 1.18 lakhs only. You assume that, or you consider the capital is 1.2 lakhs only. For 1.2 lakh capital, 4,000, is it a big loss? No, right? Manageable. Right. Now, some due to some instance, you cannot put a stop loss, you missed the stop loss, or market suddenly crashed, stock slipped down to 3% or 4%. Still loss is manageable. Still loss is manageable. Okay, you forgot the positions. Stock went 7%. Still, your loss will be maximum predefined to it will be subject to predefined loss. It cannot be more than that at all. Are we clear? Are we clear? Next, coming back. So now stock is going towards your favorable direction 6%, 7%. Maybe like let's keep 5% as a target. Why we should hypothetically think 10%, 15%. Let's keep 5%, which is very much possible. In a bullish market, 5% is nothing. 3 days, 4 days out of a capital of, again, if you consider even 1.18 lakhs or 1.2 lakhs, again, still you make 20,000 rupees profit. Are we clear? So now, where you will lose abruptly, where you will lose is when stock is not giving movement, when stock is not giving movement, and if the days are going, I took on 1st January, I am holding till 15th January. What will happen? This premium will dissolve. We know what is theta decay, right? This premium will dissolve, and actually this 23 rupees will become 14 rupees minimum because of the this fellow who is called as IV, because of the IV. So it will start giving you more losses. So the maximum holding day for this particular strategy is maybe we can keep 3 to 5 days. And if it is moving towards your direction, yes, what happens? We can hold it because it is profit. We can hold the position. If it is against your direction, please close the position when it is meeting the stop loss thresholds. Are we clear, sir, madam? Now, what happens if I take OTM? If you want to manage less margin, you can take OTM. Say like let's assume that stock is going against my trend. So if you buy ATM, you are getting 4,100 loss. If you buy OTM, what will happen is still the loss will increase. The loss will increase. 4 became 7. And margin instead of 40,000, it became 54,000. Here, the maximum loss 13,000 became 28,000. See, again, here there is no point, right? See, when we do something, unlimited loss became 13,000, which is worth. Am I right or not, sir? Sir, madam. Unlimited loss became 13,000, which is acceptable. In worst case scenario, this is manageable, but 28,000 is too much, right? In a trade, we cannot afford to take 30,000 loss. So that is the reason always try to hedge the positions, even if you are 200% confident about a future trading. So next, let's take one more stock. Reliance, I'm going to short. Reliance, I'm going to short. Short future 2933. Add put option. I'm sorry. Add call option 2940 call option buy. 2940 call option buy. So now the trick is you should not enter the trade whenever it is in the odd number. See, you should enter this kind of strategy. Okay, this we can manage. The other strategy we should enter in the round numbers that I'll explain you later. So now you can see here the maximum loss is only 14,000. Capital required is 44,000. Axis Bank is still less than Reliance. I don't know why. So now 250 is the lot size, 3% above. It is not. Okay, we have gone for a short. So when we go for a short, 1.5% is the maximum stop loss we can afford. Right. Next, when it is towards my favorable direction, I'll take a profit of 10, 12, 15,000. You can trail the stop loss and you can make profit. Right. It is 1:1. One future, one option. It is one future plus one option. If it is up, you should buy PE. If it is down, you should buy CE. Right? So this will minimize the adverse risk in future trading. One can easily sail through the next day gap up and gap down and unexpected events. When your targets are small, 1 to 2%, pick ATM or first strike ITM. Maximum risk will be 8 to 12,000 rupees. So when your profit starts fast, so when you pick a ATM along with the future, profit will start fast and profit will be high when the stock moves towards the favorable direction. Right? When your targets are big, then you can pick a second strike, third strike, but still risk is involved. Risk is involved. So when your targets are big, 3 to 10%, pick deep ITM, 4 to 6 strikes, maximum risk will be 5 to 10K. So now there is no point of speaking about buying OTM. So this strategy does not involve OTM. OTM is useless. It is not going to cover our loss, right? So 2933, when I sell the position, let's go with correct one because ulta we cannot think properly. When I buy at 2933, I am taking 2940, which is first strike ATM. I am going to buy 2900 put. I am going to buy 2900 put. I don't know why it is. Okay, I am going to buy 3000 put. So my risk became only 7,000 rupees. Margin instead of 54,000, it became 49,000. So now let's see optimization. Profit will be late. Profit will be late. It will be less considering. See, you can see here it is 10,283. But if I take a ATM, it will be 13,000. Profit will be less. Profit will become less if you buy a ITM option, but still the risk also will be less. See, in a future trading, when you pick this combination, whatever happens, when the stock is giving you big profits, you get huge money. When the stock is giving you big losses, still loss is subject to predefined loss. Are we clear, sir, madam? Now, do you have any fear in trading in futures? Now, do you have any fear in trading in futures? You can easily trade. Again, capital required is only 60,000, 70,000. That's all. But the thing is like you should buy the option first, then you buy future to get the margin benefit. Because if you buy future first, you require 1.3 lakhs. If you buy the option first, then you buy future, you require only 50,000 rupees or 60,000 rupees. This is protecting my main trade. This is just an insurance. See, there are 100 types of hedge. This type of hedging, its purpose is to protect my future trade from big losses. This is the only motive. And minimum condition is stock should give minimum 3% movement upside. 2 to 3% in 3 to 5 days. 3 days you can take. So when we get a condition for 3 days, what happens? We should see the open interest before buying. Both instrument you can exit at the same time or separately based on movement. No, you have to close the instrument together. You have to close the instrument together. Why? Because if future is coming in profit and option is in loss, we will book future. Then we will think that okay, let option come to cost, then we will close it. No, that should not be done. You should initiate the trade within 1 minute. You should close the trade within 1 minute. If you just misplace the timings, it will not become a hedge. It will not become a proper covered trading. Any doubts? Okay. So future to option. Okay. Option to be closed first. No, you should create option first. You should open the option trade first. you should close the future trade first. Right, you should close the future trade first. So next is the same setup we can implement in future index trading also, but high volatility will be there. High volatility will be there. Premium will disappear like anything. Premium will disappear like anything. That means today morning market, today it was a complete sideways market, right? So morning the premium whichever I saw for 75 rupees, evening it was worthless. It was like very less, approximately 45, 30 rupees or 40 rupees. So index we should avoid. Index we should avoid. So let's see one example in index also. If there is a very big movement, you can do an index or else completely avoid index. Okay. So Nifty future buy 22,610. Okay, this level we will take a sell. Now we have to buy 22,600 put option, monthly option. Remember, it should be monthly option. 30th April 22,600 put buy. Okay, I have to buy call. I have to buy C. Yes, direction is important. So thank you. So direction is very important. Monthly, weekly in the sense weekly premium will not get adjusted. Number one. Number two, what will happen is if future is moving upside and let's try both. So I'll explain you. So now let's see monthly. Monthly is 225. So let's say like future is I'm selling a future, but option is I'm sorry, the trend is going against. So let's say like 1.5%, not even 1.5%, 1% will keep us a stop loss. 200 points is big amount, big movement, right? So or we can keep only 0.5% as a stop loss. So 2,700 rupees will be the loss. That is future giving a loss of 5,600. Now the tricky part is option will become every day the theta will depreciate 5%. Theta decays, you can see here 6%. That means every day this option from 235 it will reduce 5% by default. So when we push 3 days or 2 days, 2,200 rupees loss became 3,300 rupees. Right. So now let's see in profit. Let's keep a target of 200 points. So we get a good amount of 5,600 rupees on a capital of 3,800. So for this Nifty should be volatile, highly volatile, and trend should be very, very clear. So technically when we do this buying is, I'll tell you when it should be implemented in Nifty. Let me tell you. Just a minute. Okay. So you can see here, whenever Nifty comes and take support in the important positions, right? Important positions. Doji, maybe when the closing day, 330, 325, we can take a position here, right? 325, we can take a position here, covering a buy or a hedge position. We can take a buy here. This is the place we can take a buy. This is the place we can take a buy. This is the place we can take a buy, right? Now you can see here, what is this? Hanging man or shooting star. So still candle is in green. So whenever we see an important setup taking support on 50 SMA, 10 SMA, we can take this kind of strategy expecting big movement. See here, if you might have taken position here, right? 22,000 went up till 22,200, 1%. So we might have got at least 4,000-5,000 rupees in same day, right? Now the same thing we'll change into weekly option, let's see what is happening. When you take 10th April option, the profit, when it comes to profit, it becomes more, right? When it comes to loss, see, 0.5%, there was a 3,000 loss there. Now it became 4,625. Loss increased. Are we clear, sir, madam? Did we understood why I'm asking you to take monthly option? If here, if it is showing 4,600, definitely it will be more only. It will be considerably, it will be more. Right, weekly option, it dissolves or disappears in no time. So we should be very, very clear about that. So keep a template like we will trade only in a monthly option, not on a weekly option. Right. So next is option to option. So we have many strategies while trading in option to option. Right. We'll be learning in the upcoming classes like bull call spread, bear put spread. So those things we'll be learning in the upcoming classes. So long straddles is also pending, right? We'll cover. So next is any doubt in this? Any doubt in this so far? Tangraj sir, yes sir. We are not finding time to create one more avenue. So we started that, but we could not continue that. So once we get some volunteers, we can start the work. We can start posting some examples over there. Maybe in your group you can form some volunteers and you can take charge. You can try these combinations for a month or for 3 months, then you can take over that channel as a masters. That we can do, right? One lot future with one lot option, that is what we have learned so far. Okay, one lot future with one lot option, nothing more, nothing less. Okay, stop loss as per technical stop loss, sir. Is it possible to put stop loss in Sensible? I never tried. Usually I keep a price alerts and I exit the position manually. So I didn't try that. Okay. So next is cover trade is over. So now we are going to learn one important hedging strategy. Okay. So future plus two option. Future plus two option. So hedging, just now we learned what is hedge. The same thing is repeated. So now hedging futures with options, just as like whatever we learned, but here with one lot future, we will buy two lot option. 1:2. 1:2. 1:2. Right. When you buy one lot future, our trend is upside. When we buy two lot put option ATM, trend is downside. When I sell one lot future, trend is downside. When I buy two lot call option, trend is upside. So now there are a very big list going to come here. Everything is mandatory. You cannot ignore any one of those lines. Are we clear? Everything is mandatory. You cannot ignore any one of those lines, those conditions. So stock should give minimum 3 to 5% either side. So now why this strategy we have brought is stock is here. We are anticipating it should go upside. But what happens? It is coming and hitting my stop loss and it is going down and down and down. This is what happening 60% of time. Am I right? Any doubt, sir, madam? Any doubt? This is what is happening 60% of the time. So now what we require is either movement upside or either movement downside. It should be minimum 3% upside or 3% downside. You'll be losing money. You'll be making loss only if there is a sideways movement for the next 3 days. Here only you will make loss. If there is a movement upside in 3 days, you will make profit. Downside in 3 days, you will make profit. So stock should give movement either 3 to 5% and above. Accuracy should be 60 to 80%. 60% accuracy is sufficient. That means you should identify that this stock is going to give some movement. Upside is also fine, downside is also fine. This is to protect our capital. So why we do hedge? We are hedging this to protect our capital. Profit will be less only. Profit will be less only. Loss also will be less only. Profit will be less. Loss also will be less. Choosing the strike price is very, very important. Choosing the strike price is very, very important. It should be ATM or first strike ITM. It cannot be deep ITM. It cannot be second OTM. It should be just ATM or just ITM. Option liquidity is very, very important. It cannot be like stock like Colpal, NTPC. These things will not work. You require a high volatile, high liquidity or high option liquidity stock. Next, check spread before creating positions. So once you see the liquidity, spread is not required, but it's good to see that. Do analysis one day before execution itself. Execute the positions when signals are clear. That means, again, I am tagging this point to here. We require minimum research. That means blindly we cannot go and initiate this strategy in any stock. Blindly we cannot initiate this strategy in any stock, right? And stop loss is important to control loss. So if there is no movement, then we have to exit the positions within 2 or 3 days if there is no movement. Maximum holding period in this trade is only 2 to 3 days. If there is a big profit, we can hold. If there is no profit, then we have to exit the trade. Our maximum holding period is 2 to 3 days only. No positions over weekend because we are buying 2 lot buy option buy. That is, we are buying 2 lot put option buy or call option buy. So this will have theta decay. Theta decay will be there. So no positions over the weekend. Avoid this strategy in the last week of the expiry because we are buying ATM or ITM. If stocks moves against us, this may become worthless or the combinations may not work properly. When you buy 1 lot future, buy 2 lot put option. When you sell 1 lot future, buy 2 lot call option, opposite side. Just now what we learned, instead of 1 option, we are going to take 2 call option, 2 put option. Buying future and buying option should be done within 1 minute. Closing also should be done within 1 minute. So let's go through the example. So now, no stop loss. No stop loss. You have to exit only when there is a. You should exit only when there is a purpose. The stock is not moving, then only you have to exit. Sir, I am okay if the stock is going up. I am okay if the stock is coming down. Why do you require stop loss? Stop loss is required only when the market is range bound. When there is no movement, what will happen? 2 days like this, your option will become 20% loss. At the time, we have to exit. Right. So coming back, I'll show you Reliance. Reliance price is 2920. I am buying 1 lot Reliance future 2933. So now the tricky part is you have to buy future when it is at the strike price. That means you can buy at 2920 or 2940. So 2933 it is in between, right? Am I right or not? Any doubts, sir, madam? 2933 is in between both the strike price. So if you pick this and stock is going against, profit or loss will not be adjusted properly. If you pick and stock is going against, again profit or loss will not get adjusted properly. So the main agenda when you execute this trade is option should be at strike price. It can be 2940. It should be 2940 or it can be 2938 or 42. Are we clear? In this place, you have to take a strike price of 2940. Any doubts, sir, madam? Especially this strategy, when you initiate, the stock price, the future price should be around the strike price. Any doubts? Can I get one line of yes from everyone? Thank you. So now, okay, let's optimize and see, or else what we'll do is we'll take some other stock. Axis, I remember, 1059 accepted. Chart is coming, 1059. Accepted by one lot future 1067. Okay, fine. Let's take this buy and buy two lot 1070 put. 1070 put two lots. So now let's say, like you can see here. So stock is, there will be a small premium 29, 23.7, 24.05. So now we are starting with 0. Let's say like 3 days going, 3 days going. If market is flat and future and option is not moving, future is not moving, this will give you loss. Option will give you loss and future also will give you small loss, because at the end of the month, these two will become same price. Either cash market will go near to future or future will come near to cash market, depending on the market trend. Market trend. But that is based on the sellers, right? No, see, this happening when there is no movement in the stock, option depreciates because of theta. Because of theta. Obviously, sellers are taking the benefit. Correct. Obviously, sellers are taking the benefit. So now, let's say like stock is giving you 3% movement upside. Sir, please remember the minimum requirement is 3% upside or downside. So now I think we have moved too many days, 20 days, 1, 2, 3. Okay, you can see we are getting only 1600 profit. That is because this 3 points is not getting adjusted. This 3 points is not getting adjusted, right? So if we make like we are entering at 1063, now you get for 52,000 rupees capital, you get 4,200 rupees approximately. So that is the reason I was very clear. So this should be around the strike price. This should be around the strike price. So now, even if the stock is going down also, you may make a decent profit. Profits will be small only. Profit will be small only. The reason is we are taking two lot of option. So it should cover the future, right? So now, where you will make big profits in the strategy is if the stock is crashing badly, you will make big profit. Future will give you big loss, but option will give you very big profit. So now, when we sold, it was 1070 put, it was ATM. Now price came to 1006. It is OTM or ITM. What is the current situation of this put option now? See, when stock was here, we sold ATM, right? So stock started coming downside. We took a put option. So it became ITM, deep ITM, deep ITM. So it will cover the loss of the future. Sir, can I buy 3 lots of OTM, 4 lots of OTM, or 1 lot of deep ITM? No, this is the combination. Other things I have not tested. So let's try with some other stock. Reliance didn't work. Let's take SBI again. 764. Let's see the future price. 768. Okay, fine. Let's try selling future at 768 and go and buy option 770. Buy, call option buy 2 lots. All buy only. Selling, it is not this strategy. So now 3 days goes, no movement. Stock will give you loss of 4,000 rupees. So now before we make an entry, we should check is the stock giving 3% or 4% movement in 3 days. A very basic understanding, right? You take last 3 days, okay, mark a line. You take last 3 days. $753, 775. Is that sufficient? No, right? It is not sufficient. It is not sufficient. So we have to pick a stock which is giving 3% or more in the last 3 days, minimum in the last 3 days. 2904, 2984, 3%, approximately 3% is there. We can select this. So maximum stop loss, yes, I missed it. I'll come. See, what you can do is, yes, HDFC can be taken in the current situation. HDFC Bank we can take in the current situation. You can see in this place, blindly go for a buy. See, I'll say in simple example, I'll say wherever you see 2 or 3 bullish candles, you can blindly implement the strategy. Either it will start going up or it will start coming down. You can take, so it was Dabur was in the Fibonacci level, right? So maybe when you see one reversal candle, you can initiate this trade or Bandhan Bank. Okay, so you can see this is the place you might have initiate a short future and buying 2 lot call option. So 203, 189, it is more than 3%. So like this, we have to select the stock. So what you can do is you can go through this screener and you can go through this DATR, daily average trading range. Daily average trading range. You can select which is more than 3 to 3 or 4%, not 2 to 3%. You can select more than 3 or 4%. Let's say like, I think it should work. So you can see here, this particular stock is giving 5% movement. Symbols are collapsing. Data filter, create filter. Okay. So now short by, I don't know why symbols are disappearing. So this I'll get it rectified and I'll give you. So in simple, you can go through this. You can see these are the datas where, just a minute. These are the places where we have more than 3%. 3%. What stock? Bsoft. Liquidity will be bad. Brillasoft option liquidity will be bad. So how to know this? Only based on experience. Next is CUB option liquidity will be worst. Glenmark, okay, we can take it. Godrej Properties option liquidity will be worst. HAL good option liquidity 4%. ICICI Pru Life option liquidity will be bad only. Adani, yes, we can take Adani also, but it's like a mad stock. If it is roaming both the sides, what will happen? It will eat our premium. So you can avoid at least Adani. That will be my minimum requirement. That will be my minimum thing. Other than that, you can take any stocks which is having good liquidity. You can try in Adani. Dummy trading you can do. There's nothing wrong, right? So these are the very important hedging activities. Just a minute, I missed somewhere. Okay, examples we have seen just now. So trade time to trade and failure models, double top reversal, double top reversal. So now when market reverses in top, you can go for a sell and you can take 2 lot call option. right? Double bottom reversal, same like that. In this place, you can buy future plus 2 lot put option. Any reversal pattern, any stock Phoenix trade setup we can take. Failure reasons, wrong proportions, wrong durations, sideways market, small loss will be there, manageable. Wrong timings, buying 2 lot options in morning and buying a future later and closing later, that is not accepted. You have to do this as a combination only. Wrong stock selection, that is very, very important. So trading should be done in pair. So these are the minimum requirements. So this straddles and strangles we'll see tomorrow. It will be too much of confusions. Any doubts, sir, madam? Deep ITM strike. If you go with deep ITM strike, loss will not be covered. Let's say like, let's take this 2 lot. What is this? SBIN, right? So let's reset. Let's reset. Let's say like buying. Okay, let's say like deep buying 750 call option. Okay, now stock is moving upside. Stock is moving upside. So when you are short in future, that is your main trade. So you will get more profit. It is 1 lot, 1 lot, 2 lots. Okay. Next, when it goes against you, you will start making big losses. Deep ITM, just a minute. Let's keep it 2%. We should take 770 call. So you can see this 1200 rupees becomes, when you take a deep ITM, it becomes 5000 rupees. So now maximum loss will switch over this to maximum loss is 50,000. So why it is 50,000? Because this is calculated based on the premium value. You can see here. This premium value plus the future premium value is coming as a risk. If you hold this trade for 15 days, we are done. We will be dead meat. Why? Because both the options, if it is not towards our direction, both the options, this 15 will become 0. So we'll end up into very big loss. We'll end up into very big loss. That is the reason the condition is 3 days. The condition is 3 days. Right. See here, what happens? We lose all the money in the premium. We lose all the money in the premium. Only 3 days holding period, no weekends holding. Create the strategy and implement on Monday morning, close by Wednesday. Implement on Tuesday, close by Thursday. Implement on Wednesday, close by Friday. Implement on Thursday, close by Friday. If you start this on Friday, you have to close by Friday. No doubt at all. If you start this trade on Friday, only 1 day holding period. The life of this trade should be, strategy should be only 1 day. Is there anything to be maintained between future and option premium? Nothing to be done. You should make sure that whenever you enter the trade, future price, not stock price, spot price, future price should be matching the strike price. If it is 440 call or put, if you are picking, you should go buy or sell future at 440 only. It can be plus or minus 1 rupees. Is there any time frame to be maintained for future and option premium? 3 days, sir. Maximum holding period is 3 days. One deep ITM can be equal to 2 ATM. No, no, sir. It will not work. It will not work. Both the strike price should be same or different. Both the strike price should be same, sir. You cannot pick a different. You cannot buy one OTM and you cannot buy one ATM. Future and option, it should be in the same strike. That means if it is 640, then when the future is at 640, buy 640 call or put. Right? Any doubts? Thanks a lot. Next session will be on Tuesday evening. Next session will be on Tuesday evening, I think so. So I'll update it in the channel, right? I'll update in the channel, communication channel. I'll update it. I think I have updated. Let me check with Prabhu also, and I'll get back to you on this. Okay. So my slot is free only. If Prabhu is not available, evening even I can take. No, I have one more session. So Tuesday evening will be the next session. Okay. So it's a confirmed thing. Next session will be Tuesday evening. So it's my humble request. So start practicing this in the Neo Stocks, I'm sorry, Sensible platform. See this strategy, you can just initiate, add to virtual trade. You can add as April, and you can make it as what is that, SBIN. That's all. So you can see the results after 3 days, 4 days, 5 days. You can see the results, right? Some new signals testing is going on, right? We are also trying. Some losses are there, so I don't want anything to happen to others. So today sideways market, I got fully trapped. So almost many made losses, including me, right? So let's clear all the indicators. Let's come up with the proper setup. Let me try test with my capital for 3 months or 2 months. Then it will be given to everyone. Right? As of now, it is good. It is a we can tell that as a trend continuation indicator. Trend continuation indicator. Please join tomorrow's morning session. Prabhu will be explaining more on that. Tomorrow there is a free webinar, right? You can join those. Join that webinar. Maybe Prabhu will give more insight on that. If you're free, you can join. Nothing mandatory, right? Thanks a lot. Let's meet on Tuesday evening, 7 p.m. Thank you. Good night. Happy weekend. Price difference is more than 10 rupees for current market price and future can be entered. Yes, we can do. Because we don't have anything to do with future, spot and future now. We are going to trade only between future and option, right? So spot can be anywhere. We can trade here. Thank you.